Danny Newberry, welcome to the REI Diamonds Show. How you doing today?
Hey, I'm fabulous, Dan. Thanks for having me.
So we're going to get into investing in commercial real estate with Vale Commercial founder Danny Newberry, who's on the call here. He and I have been friends, business partners for the past several years here. He's got an interesting journey to the place where his business is now. We are going to dive into a lot of that. I figure maybe we could start. Well, I location stamp a lot of the episodes, so listeners recognize that, know it. I'm in Florida, and whereabouts are you right now, Danny?
Hey, I'm in beautiful Scottsdale, Arizona, man. 80 degrees and sunny.
Sweet. I think I'm 79 and sunny, so I know the feeling.
Oh, man, living it up.
Yeah, man. Why don't we start? A lot of the people on in my network and the audience of the show, we have a lot of house flipping, we have a lot of real estate agents, we have commercial real estate investors, and I mean, going out on a limb, there's a lot of people listening who would love to make the transition as they see people closing commercial deals, hear about refinances. There's just this gravitational pull, if you will, from larger deals to the starting place for a lot of investors in residential real estate. So would you mind kind of going through the thought process and the moments in time as you shifted your gears into commercial real estate?
Absolutely, yeah. So I'll kind of take you back from the beginning. Essentially, when I was in high school, my grandmother actually gave me the book Rich Dad Poor Dad, and I remember reading it, and it just struck a chord, man. I was like, oh my gosh, like, okay, this is awesome. I've been looking for something. I had probably already started half a dozen businesses that were, small time businesses for a high schooler, but candy machine vending business, kitten smuggling from Utah to California, and a handful of other ones that were semi-profitable. But ultimately, when I read that book, it just really hit me that wow, I think I can create what I want with real estate. And at that time, I was really kind of going down the multifamily path. And so I had started with, I think my first building I ever bought was a vacant sixplex. It was my first year of college, and I put it under contract for 155,000. Ended up closing it with my best friend's dad, who was a hard money lender. He gave me the 155 plus 30 grand to fix it up because it was completely vacant at the time. And with it over the summer, had fixed it up, filled it up, and it appraised for over 300 grand. And I'm like, holy moly, why would I go back to school for a degree I don't have to make less money than I made on my first, real estate deal? And that was kind of the eye opener for me that I'm like, this stuff is real, it works. And, I want to go into this full time. So I quit college, ended up going after a lot of different assets in southern Utah. And then I decided to move to Las Vegas because I was like, man, I need to go to one of these hard hit markets, either southern Florida, Phoenix or Vegas. And I lived like 2 hours from Vegas. So I'm like, this makes the most sense. Ended up moving out there, bought a ton of these fourplexes and 10plexes and smaller apartment communities, right? And what I quickly realized was the management intensity was overwhelming and my cash flow was not there. I was buying these things super cheap. And I will say, it probably didn't help that I wouldn't even consider them class, C or class D kind of locations. They were more like war zone properties in Vegas. And so, yeah, your tenant mix is not always the greatest, but at the end of the day, I was like, all right, I need to scale up. So then I started going after some larger apartment complexes. I bought a 48 unit. I bought a 138 unit apartment. And then that was where I started to realize, like, yeah, having a team on site that can, basically manage the asset versus trying to have a third party management company manage it from afar. It just made a, night and day difference from that standpoint. But then something really interesting happened to me. I was working on all these apartments, and it was a lot of work. It was not easy. It was not passive by any means. So don't let anybody tell you that that's the case. But I had an investor of mine who owned a ton of shopping centers and industrial buildings and a couple office buildings. And one day I asked him, I go, hey, why don't you own any apartments yourself? And he goes, oh, I don't want to work that hard. And I go, what do you mean? He goes, I only buy triple net lease deals. And I go, well, what's that? And he goes, oh, well, it's where the tenants pay your taxes, your insurance, and all the common area maintenance. So anything that's interior in their suite is their problem, and everything that's exterior gets billed back to them. I was like, wow, that sounds amazing. So like when a tenant, beats up my unit at my multifamily property and leave it trashed, the only thing I can really do is evict them and go after them in the courts, which is usually cost me more money and time than it's worth. So I was like, this sounds really intriguing. And that's when I really started to dive into the commercial sector, where I then went off and bought an industrial building, a medical building, and a shopping center. And I was like, man, I just loved it. I remember you sign a lease, you add a couple 100,000 here, 500,000 there, $1 million here, literally with a signature. And I was like, this is incredible. Now it's financeable. I can go to the banks, I can refinance before the tenant's even in and operational. I could go refinance, and if I needed to do tenant improvement, and I can borrow that. Like it was just a whole different mentality. So I call it like the evolution of real estate investing, where you might start off with like single families, then you scale up to apartments. It's a really easy concept to go from single family to multifamily. But then going over to the true triple net stuff it was a learning curve. It doesn't happen overnight. It's a different language. And you just underwrite deals much differently. I mean, everything from, leasing to, the way you stabilize these things is just different. But at the end of the day, I just fell in love with it. I really feel like I found my niche within retail and industrial, and that was kind of the beginning of a long-term business plan, and what we've been focused on over the last decade. So
Yeah, that's good stuff right there. The evolution of real estate investing. So I just exited like 35 units between two buildings, I think. The 1031 exchanges are still open. If they don't close, I don't care. I'll pay the tax. But I'm in this like odd place with that. There was this false sense of security, Danny, in owning those buildings. Like, oh, I'm paying them down and someday they're going to be, better rents and the whole thing. And if you do the math on the turnovers, like the 15 unit building had like, while I was under contract, the to sell the property, I think like 5 evictions started. So it's like a third of the building, and they might have worked it out and got them paying again. I did not even look. I was like, I was so at the end of my rope with that. And as I look back through the ownership of both those buildings, every year, every penny of the cash flow was vaporized by 3, 4, 5 months of no rent while I'm getting a tenant out of there. I'm paying to do the turnover. I'm paying a leasing commission again to get it full. And then maybe I'm evicting the same tenant in like month 9 or something of the new tenant. I don't really know if that was the case or they were the old tenants. I didn't even bother to look that close. So I say it's a false sense of security. And again, this is probably C or D grade, like you said, the kind of rough apartment areas to own, and maybe it was an asset class thing. And there's multifamily investors laughing at me right now. Ah, what an idiot Dan Breslin is for investing in the wrong class. But I think there's a sense of freedom that comes from that. And my money's now, I don't know, 70% in ownership of, as far as like my net worth, industrial self-storage. We're doing self-storage development as we speak. Uh, the center that we own together, it's those are passive for me. The partners are doing all the leasing, the partners are overseeing the construction. There's a quarterly, management statement that comes out, I guess, or partner report, I guess it would be. But man, it's just weird to have that false sense of security that's like fictitious. I mean, there is net worth there, and there's large checks that came from the sale of those apartment buildings. There's profit there, but the actual ownership of them was such a break even, if not negative tens of thousands, maybe 100,000, depending on how much repair had to go in a given year. That man, it's just got to be really hard to sustain that versus the triple net lease into the industrial. So that's like some of the, I guess, the pain. I'm done with the pain of those apartment
I gotta
deals.
tell you, man, I got into real estate because obviously the book, Rich Dad Poor Dad, was like, hey, assets put money in your pocket every month. And I never realized that with apartments. I had a couple apartments that did okay, but for the most part, the portfolio was break even, if not negative, constantly. I mean, it was a never ending battle. And it wasn't until I got into the triple net business, that I really started to see what coupon clipper, cash flow, steady Eddie, you can project it out for, many years in advance of what you're going to get based on your rent roll. Because the tenants don't sign 12-month leases. They sign, you know, 3, 5, 7, 10, 20-year leases. And people always talk about this. I always hear it out there. Oh, well, that's really risky. What if they go out of business and this or that? And it's like, yeah, that happens, especially for like, people that are just starting. And I mean, look, we gamble all the time with that, knowing that we can turn that space around very quickly, and eventually we're going to get somebody in there. And then when you find the right operator, they typically are in business for a long time. So like we'll find, a nail salon, for instance, and they've been around for a decade, and it's like they're humming along, they're doing great, they're financially successful, they've got good clientele. They're not going anywhere. I mean, I don't see that industry changing. And we're primarily focused on the small bay industrial and small bay retail. We just know that we can backfill that stuff so quick and easily compared to trying to backfill a grocery store box or, 100,000 square foot logistical building like that. There is a lot more time and money involved to get those spaces leased versus a 1,000, 2,000, 3,000 square foot box. And with the apartments, I just never realized the cash flow, and I always wanted passive income. That was a goal of mine, was like, hey, I want to get to X amount of cash flow so I can live a certain lifestyle. And the apartments just didn't do it for me. I always made my money when I sold, every time, on apartments. Never made it.
Yeah,
So maybe I was
yeah,
doing wrong, but I was listening to the big guys, you know.
yeah, you and me both. Now here's another part of the growing pain, I guess I could share of my own. So when I first started buying houses and renting them out, and apartments and renting them out, one of the fears I had was, oh my gosh, what if somebody doesn't rent this house and it just sits vacant? I've driven by vacant houses like for a decade, 15, 20 years, houses sitting vacant. So I assumed that was a risk I would have in residential real estate. That did not at all turn out to be the case for any of my units. Like 30, 35, 40, 45 days on the market for a rental was kind of a long time, no matter if it was a single family house or an apartment unit. And this is actually, granted, we're in epic bubble times of real estate in all of history for the United States. So it may not have actually been you turn around your unit and get it rented in 30 to 60 days. That may not have been reality a decade ago, 15, 20 years ago. I don't know. Doesn't really matter. But I got comfortable with that speed and that timeline. And we just did a triple net lease on a warehouse, single tenant warehouse deal. I think it was like we're March, we just got our first rent payment. Uh, we were vacant for like 4 months. I think we may have been 6 to 7 months like on the market. We went on the market. So 6 to 7 months, and we filled 30,000 square foot space with a decent enough lease. But man, that felt slow to me, Danny. I am so used to speed in the residential game. It's like houses are liquid, man. Apartment units are liquid. Is the small bay industrial and small bay retail sector? I mean, what is the average, say, days on market timeline when you're going to turn that unit and backfill it quickly?
Yeah, no, that's a great question. So I'll tell you, it's a lot quicker with small bay industrial. If you've got 1 to 3,000 square foot bays with a small 500 square foot office, one bathroom, and just warehouse space, I mean, we typically will have a waiting list. If we get it out there on the market, I mean, never more than 30 days for the most part. It's
Wow.
stuff leases up fast. So we've had great success in that. We've had great success in getting the lease rates up, and typically, like even on those, um, on the true small bay stuff, we don't even like to sign long-term leases anymore because the lease rates have been going up faster than the 3% that you would typically put on a normal lease. So if you're signing a 3-year lease at $10 a foot and then you add 3%, that's only 30 cents a square foot a year. I mean, we've had it where we've gotten a buck or two every year in increases on a property. So yeah, on some of those we like to do shorter term, just so we can get it to market faster. But anyways, on the small bay retail stuff, it depends. I will tell you, if you're holding out for nationals, that can take a long time. I mean, holding out for a national, if it's even national worthy, every center's different depending on, your ingress, egress, your density, your rooftop density, your traffic counts, all these different things come into play. But from start to finish with the national tenant can take 3 months. I mean, I've had it take almost a year from start to finish. When I did a Starbucks deal, that was about a year. So it just
And
really,
that to clarify, Danny, that year was what? The moment the agent first looked at the site, or
yeah, from the
what
time
was
they identified the site and said, "Hey, we're interested." Yeah,
okay
took a long time from start to finish,
to
but we had to
to
do
sign the lease?
right, and it was just a piece of dirt. We had to do a whole build to suit. So we actually had to negotiate, hey, what is it going to cost the landlord to actually build the structure for Starbucks and deliver keys to them where it's basically move-in ready, right? So there was a lot that went into that process. If it was already a box that was ready to go and all they had to do was move in, it would have been a lot quicker, but this was a true build to suit. And then if you're going with mom and pops, I mean, it can be quick, man. I mean, even like on our deal that we've got together, we had a lot of mom and pops move in, and we've had a couple of them not be successful and not make it. But because the units were rent ready, they were turnkey. Essentially, when we got it, they were second gen spaces. They needed some work, so we had to go in there and clean them up and build them out. But now that they're built out, that tenant doesn't make it, there's typically a lot of people that can come right in and literally just take it as is, or very little build out at that point. So that could be anywhere from 30 days to maybe 90 days. Yeah, for the most part, when you're dealing with these mom and pops, you can sign a lease pretty quick. A lot of times they're like regional tenants. Maybe they have 1 or 2 or 3 locations around town. And so, those are just a lot easier to get done than a national tenant.
So on the build out that could be recycled,
Oh,
are we
totally.
talking? Yeah, are we talking like there's a half bathroom, bathroom, maybe 2 bathrooms in there, and like a counter from the tenant who failed? What type of like actual build out is there? You're not just like re-white boxing it all over again,
Right.
right?
So like, I'll give you an example. We have this liquid, it's called liquid. They do like acai bowls and whatnot. And they're not making it. So anyways, we've got actually like 2 other tenants that there's just not enough hood space in the market that's open and available for these little restaurateurs to come in. And so if you've got a hood and you've got, basically a move-in kitchen ready to go, there's a hand, like there's
Mm.
kind of a waiting list for those type of suites. So you put it out there and you're going to immediately start getting action. And then you kind of get to sift through and decide, hey, who do I want to put in the center? What's going to be the best fit? Who's got the best financials? Who's got a good forecast, or has, existing experience in other locations. So you look at all those different factors and to determine who's going to be the best fit. But yeah, like something like that, we don't even have it out to market, but we already have a list of tenants that would take it like that if it were available.
What's the cost on? I assume the TI was your responsibility originally to put the hood and the kitchen in. What's that number?
It could be anywhere. It depends on the build out, but call it, 20 to 50,000, probably in that range.
And is it normal for the landlord to do that for those type of tenants?
Totally. So well, no, yes and no. So I'll tell you the difference between us and other landlords. There are two type of landlords. One landlord, which we love buying from, is the type of landlord that doesn't give their tenants any tenant improvement dollars, doesn't fix up the property, and essentially wants to lease everything as is to anybody coming in. So whoever's coming in is going to put the full investment into the space. But here's where I see the value and why we don't do this is that they're typically going to get we'll just call it market rate rent for an as is space would be $10 a foot. But if we go in there and we do the tenant improvements and do the build out, we may get $20 a foot for that same space. And when you look at it on a cap rate, we might be creating, $6 to $10 for every dollar we put in the building or in the build out. Right. So if we're going to go put in 100,000 in tenant improvements, I'm hoping that increase the value of that space by $500,000 or, whatever it might be. It's going to be significant compared to the investment in the space. So if we're handing it over turnkey like that, we're going to demand a much higher rent, ultimately resulting in a higher value of our property.
Yeah, and then you got the benefit of the backup plan if they fail, that equipment is yours and that
Right.
tenant is not scrapping all the equipment they put in there and turning over a box again
Correct.
that
Yep.
needs a bunch of work. How often have you exited? And because when I'm underwriting shopping centers myself, I can see the TI packed rents in there. Like, no, we're not getting $34 a square foot for this space. It's just not happening. The market does not demand $34 a square foot. It might demand 15 or 17, but there's a TI package in there. And sure enough, there is some kind of TI package in there. And that makes me hesitant as a buyer to want to pay NOI type of income on some of that TI dollar for dollar. Have you been successful in selling that to the next buyer and, getting full freight on the cap rate and the TI packed rent?
Yeah, so I'll tell you, we don't like to do that in general where we're like way beyond what the market is. Cause yeah, anybody's going to come in and underwrite and say, well, look, all the other shopping centers in the area trade, lease rates are between 10 and $20 a foot. And if you're at 34, I mean, you're just so far off the mark. So, anyone who's going to come in is going to discount that, right? So we want
Yeah.
to be at the higher end of market, whatever that is. We don't want to be above that because then, yeah, again, we'll get dinged on it on our exit. So we are conscious of that. There are certain occasions that you're going to get a higher rent, and you're just like, okay, well, if I hold it, I have a higher cap rate, better cash flow, and if I want to flip it, you just got to come to reality of what the market is and what someone's truly going to offer you, and you're good with it, then great. So
How much of a discount will the bank ding you on the refinance for that $24 a foot for the built out TI space? Are they also taking some off of that income?
typically they'll be a little more conservative on it. It's typically like a give and take, because you can go back to the appraiser, you can go back to the bank and say, hey, look, we did all these finishes. To do this finish, it's kind of like a nice restaurant, right? You go into some restaurants and they have a, couple $100 a square foot and tenant improvement you can see. You're like, wow, this is really nice. And you go into the other guy and they're a $20 a square foot build out, and you can tell, so there is an argument to be had and to be made for that. And so that's just really kind of laying it out for the appraiser and for the bank and letting them know, like, hey, here's the reason it's at this, and it may not even be like your comps are on this street, but if like you're in a city and you can point to other restaurants that are within the city and say, look, like here's a comparable, build out and their valuation and what it traded for, right? So you could, instead of looking at it from more of a localized aspect, you're looking at it from more of a macro point of view.
Yeah, it makes sense. I mean, you build a nicer house with nicer finishes, it should appraise for more. You spend, $650 a foot building a house versus 185. Clearly, that's multi-million dollar home versus the starter home. So that's logical. So Danny, where do you fall on the buy and hold forever spectrum versus everything is sold as soon as it's baked and ready, right? Some investors that we would hear about are like, hey, the guy held everything forever. He's 90 years old. He's got $100 million in real estate and it's all paid off. And then on the other end is, nothing's probably in portfolio more than like 49 months and it's all sold. A lot of times to pay investors off and kind of keep it going. So where at on that spectrum do you lie in general? I know that deal by deal is clearly going to be
And that's a
impacting that.
question. So I will say, like, so I have two buckets, right? The fix it up, fill it up, and flip it, and then the long-term hold, refinance and hold it, right? It's been different lately, and it's been, the market's constantly shifting. But I will tell you, like, from my standpoint, if I don't have any partners or I only have like one or two partners, love the idea of holding long-term, and especially if I love the asset, love the area. Um, to me, I'm guilty of in the beginning of my career selling way too soon. Because I wanted to, number one, pay off my investors, number two, get some cash in the bank as I was building up my nest egg. But now it definitely we're looking at stuff on a long-term hold aspect. And so when we come to the point where it's ready to either exit or refinance, we're looking at the market conditions. Like right now, it's not the best time for long-term fixed financing. Putting 10-year debt, and you're going to get, you're going to be at, 7% plus. It's not as attractive, obviously, as it was a couple of years ago, right? And it changes the projections of what you were looking to do. So for me, I am still holding quite a few things for the long term. But they're not in big syndications, or they're kind of smaller deals. Not all smaller deals, but smaller partnerships. And then like for larger syndication, yeah, typically, I mean, unless we can refinance and pull out a majority of the cash, we're probably flipping out of it for the most part. I mean, some of these I'd love to hold long term, and it might be one of those things where we'd go back and say, hey, like, who we're going to go in for a refi, who wants to stay in and who wants to get out, so that could be a conversation had. But I definitely agree with you that there is something to be said for never selling. I have partners like that, and they are some of the wealthiest people I know. Cash flow is amazing. They can live any lifestyle they want. So I'm trying to do more of that, and just really build up, a really quality portfolio that never sell. So we do a lot of deals though, so we're constantly recycling money and then we're holding certain things. So that's why I say I have two buckets, and it's nice because one generates cash and the other one generates cash flow.
Yeah, you almost can apply, when I get residential houses, you're fixing, you're flipping, there's a finish line, and it's 6 to 12 months from the day you go to settlement on the A to B purchase. Fast, transactional, in and out. If you're going to build a portfolio of houses, 10, 12, 50, 100 or more, if you're going to buy apartment buildings, if you're going to buy any of these assets that we're really talking about here, with maybe the exception of like the build to suit Starbucks, is a little bit of a set it and forget it and less of a business, more of a real estate investment. These are businesses, Danny. Like every single one shopping center that is valued at 15 to 20 million dollars is a business that has to be run. It has to be managed. Someone has to do the snow. Somebody has to do the landscaping. Someone has to renegotiate the landscaping contract. Someone has to drive by and make sure the landscaping contractor actually did the work. And it's a never-ending business. So it's almost like you could apply the Warren Buffett sort of mindset to any of these assets as well. It's like, which of these businesses like has a moat in the form of the location, has a competitive advantage due to the traffic patterns that exist for that specific business, right? It's an advantageous piece of real estate, and maybe it's an advantageous tenant mix that you put together, and this thing is just working magically. Man, if you could hold that one, you would really regret selling that one later if it turned out to be this like quality business in the way that Warren Buffett might talk about it. Whereas on the other end of that is there's probably a whole lot of other subpar businesses that somebody wouldn't want to own, where they have to go out there and run the lawnmowers themselves and the landscaping thing all the time versus somebody who's built up some team with, 100 trucks and 100 teams who are doing the lawnmower. The larger scaled up business would be one you'd want to hold forever. And a smaller mom and pop one would be one that maybe it is worth buying that one for 1 million, putting in some marketing, putting together the business and fixing it a bit, and then selling it for 3 million and making the check and keeping it moving. But I think when I realized that my rental portfolio was a business, and the reason that I sold most of it already is I knew that I didn't have the time and bandwidth to apply building a great business to manage my own real estate while I was in the middle of building, running, and managing Diamond Equity and flipping a couple hundred houses a year, right? So I made a decision that my energy was going to be a better return on time for me and my partners in the main business, and that was what is driving me to sell the rest of that portfolio off. So it's like this concept for me of looking at every one of these balance sheets, the rent roll, the income, the expense. It's a complex business, maybe not as complex as some other businesses that you might buy, and we can analyze the risk in these commercial real estate assets, these commercial real estate, businesses one by one, and you can see the comps a lot easier, and you can see the potential for the income a lot easier to mitigate the risk compared to other businesses. But at the end of the day, you're buying an operating business, and maybe the seller didn't realize that's what they had, and you're implementing these systems to build the value there. But man, holding on to the great businesses for the long haul, the great assets, yeah, great place to be.
Totally. I have a friend who's owned a lot of property, and he told me this was, I don't know, maybe half a decade ago or something, because I asked him, I go, how do you know when to buy, or sorry, how do you know when to sell versus hold? And he goes, Danny, you never really know going into a deal. He goes, I can't tell you why or what, but like you can get into something that looks amazing and it becomes your worst nightmare. And one problem turns into another, which turns into another. You solve one, another one comes up, and he goes, I can't tell you why, but those ones, after about a year or two, you'll figure it out if it's a holder or if it's, flip out of it, is his philosophy. It's just really, you might buy something and it's just steady Eddie. Never, you spend very little time managing it. There's no headache involved. It cash flows really well. He goes, those deals you just got to hold on for the long term. And he goes, you'll know a year or two in. And I go, that's interesting. That's an interesting thought of like, you think you're going to go into something and hold it forever, but I've had those properties and they just, one headache after another, and so that's kind of been something I've implemented somewhat into the buy and hold versus buy and flip model.
Yeah, I love that rule. So what's the least amount of money you've ever put down on a deal, excluding, oh, we raised 5 million for this or whatever, and so I didn't put anything in there. From a creativity standpoint, Danny, what's the least amount of money you've had to put into a deal? Commercial
I've
deal.
gotten to a deal with nothing, but yeah, I mean, let me think here. Like, are you saying like I was able to borrow all the money with existing relationships that I have, and no partners? So I've done deals like that. I've done seller financing deals. I've done deals where I literally got preferred equity and I got cash back at closing. So I actually got a big check. I just closed one actually in December. It was a $15 million deal, and my down payment was $866,000. And our year one cash flow is $260,000 with 2.5% rent bumps every year. I'll have all my cash flow or all my cash out in year three. So, and I have an 18-year sale lease back on that deal. So that's going to be a nice long-term steady Eddie, yeah, it's going to be a good
And
one.
is that what's it called? Personal guarantee on that loan?
Nope. Non-recourse.
So you have the 866 at risk until that money's back out of the deal.
Correct. So
And then
3
after that,
years.
it's smooth sailing.
Yep. I have risk for 3 years, but we got a CMBS loan on that one. And then we had preferred equity from the sellers. There was a ton of background checks with this tenant. So they've been around since the 80s. They were about 160 million in revenue last year. And CMBS literally went through all of their ledgers, all their clients, called them all up, verified everything. And at the end of it, they said they're as solid as a Starbucks. I was like, wow, that's great.
Wow. Is this the Reading deal?
It is. Even, yeah.
No kidding.
Yeah.
Sweet. Congratulations.
Thanks. Not that Reading's great, but the tenant and the cash flow are fantastic.
Yeah, there's something to be said there because I am from Delaware County
Okay.
and Reading is like Berks County. So it's probably about a 45-minute drive from where I went to high school to
Right.
Reading, PA. And any of our listeners in the Philadelphia region are like, oh my God, there's nothing at all worth $15 million at all in the whole city of Reading.
Yeah, maybe they'll
Um,
together. I don't know.
yeah. I apologize to my Reading listeners if anyone's there. And actually, the single family there, I mean, the market's actually gotten pretty freaking hot. I'm shocked at what properties are selling for in Reading. So it is one of those beneficiaries of the market. What seems to be now that the housing shortage has kind of pushed the demand into markets that didn't have a lot. Reading happens to be benefiting from that. So I think long term you could see some change over there that's helpful. But what I learned is, man, it is so easy to judge a book by its cover in the commercial real estate business. And a lot of money is made in areas, Danny, where the locals are like, dude, you never buy anything there at all. Right. So, like, I'm sure there's a lot of people who take the call on that kind of a deal and they're like, no, we're not going to touch anything like that. Never going to happen in Reading on this specific deal. And they would have never, I don't know, digged in a little deeper without any
Think
disclosing
about it.
confidential.
I was just throwing this out there. Like, think about all these QSRs that we see, right? These old Starbucks buildings, these old, Carl's Juniors. I mean, those buildings are crap, like, especially if they're over 20, 30, 40 years old and they're still sitting out there. But if they have the right signature behind it, it's worth millions of dollars. If it were vacant, it'd be worth a couple $100,000. You know what I mean? So it's all about who's backing that lease and how long it is, right? So.
And maybe that's the answer to the question that I was thinking. It's like, what made you want to dig a little deeper on that one as it crossed your plate in the first
So
place?
here's what made, okay, so where that came about was when the interest rate market changed and shifted from, the low threes, mid threes, and went skyrocketed up to, the sevens. Basically, everything went stagnant in the commercial world and probably the residential world too. For a while there, just like there wasn't a lot of transactional volume going on. And I was wondering to myself, I'm like, well, if I can't go borrow money at 3% anymore, and I have to borrow it at 7, and I have to go buy that same deal at a 7 cap, there's no spread. There's no, you're not getting a spread between your debt and your cap going in. How do you make deals pencil or work? And so we went a whole year without buying a single asset, which was, the longest time I've gone since I started. In 2009 of not buying a deal. So it was a dry spell, but that's when I came up with the concept. I said, well, what if I could pay their price, get their cap? I'm the only I'm the only buyer at the table, but I'm going to have them stay in for my equity. And the way that I'm going to structure it is in a way that secures my position in the asset, so that way I'm not at risk for if it doesn't work out, right? So basically on that deal, it was a sale leaseback, and we use their equity to be our equity, giving them a return on that equity that was lower than the 7 cap, so it was like 4%. And it's basically tied up for 18 years. And if they ever stop paying rent, it gets wiped out within 1 year. It's 5x damages. So now my basis in the asset is no longer 15 million. It is 5 or 6 million. And so it changes drastically if they ever bailed or whatever. And then on top of that, I got non-recourse debt for the first position loan. And that was the only way that deal would make sense for anybody, was re-engineering it to make the numbers work. And so I've, said, hey, if we could do that on other deals, there's lots of deals out there that are stagnant, sitting out there, not moving, not trading, because there's just no gap. The only person that can make it make sense is an all cash buyer. So that
Yeah,
was,
and who wants to do that,
yeah,
right? On the stabilized sale leaseback deal at like above market cap rate, basically, right?
yeah, exactly.
Interesting. So what are your favorite asset types these days? 2025, in the market now. What kind of calls are you looking to get right now as we speak?
So right now, highly focused on small bay industrial, multi-tenant assets. So call it somewhere between 10,000 to 100,000 square foot multi-tenant industrial facility, where the unit sizes are somewhere ranging between like 1,500 square feet up to like 5,000 square feet. There can be some bigger ones, whatnot. A lot of times you can cut those back down though into smaller units, but I love the 1 to 5,000 square foot bays. That's ideal. And then small bay neighborhood shopping centers. So 1 to 5,000 square foot, suites in a neighborhood shopping center where, you've got your Subways and you've got your, taco shop and your barber and, yada, yada, yada. Those are what we're looking for, man. But typically everything we're buying is, there's got to be some meat on the bone. There's got to be some value add, whether it's vacancy, whether it's below market rate rents that we know we can turn. A lot of times the properties need work. They need to be really refreshed and cleaned up and properly managed. And so, yeah, we're, doing a lot of that stuff in the Rocky Mountain and Southwest, call it the Southwest Rocky Mountain region. So Arizona, Vegas, Utah, Colorado, New Mexico, Texas. Those are our primary areas of focus. Although we do stuff, around the country. We got stuff here and there, but yeah.
How the hell do you manage something, let's say in Memphis, Tennessee, living in Scottsdale or Utah or somewhere that's like 6, 7 hour plane ride?
Couldn't do it if it was a small apartment building, that's for sure. But with retail, or industrial, typically we'll get some boots on the ground. A lot of times it'll be one of our tenants that gets a discounted rent, or if there's somebody local that we trust and we know, maybe it's even a management company that we're not paying them the management fees because we run all the accounting through our teams, and we run all the calls and field everything through our office, so we know what's going on. We have a handle on every property. But we like to have someone that is boots on the ground, walking the property, whether it's, weekly, or a couple times a week, and they're reporting to us of, what's going on. And a lot of times, look, you talk to your tenants, they're going to tell you what's going on. No, if there's anything, weird going on or deferred maintenance, you're going to hear about it. But yeah, having boots on the ground, I'd say, is the number one thing. You always want to find someone who can really kind of be your eyes and ears on the ground. And then you can manage from anywhere, really, because as long as you know what's going on, and I mean, no reason you have to actually physically be there as long as you have somebody that is.
Do you guys implement any kind of technology like camera systems out in the parking lot or anything like that as a standard procedure?
Totally. Yeah. Yeah. Camera systems are great, especially if you're going to hold long term. It's worth the investment. So camera systems, again, a lot of times we'll either try and get one of our tenants to kind of be our eyes and ears. And they're usually, when you do your tenant interviews, someone loves to be that person. Like, you can tell pretty quickly, like they're going to tell you everything about the center, everything about the property for the last 20 years. And you're going to learn more than you ever would have looking at anything on paper. And then, you ask that person, hey, how would you like to, be our eyes and ears? And then they feel like they're really part of the community, part of the center. And it's, it's great doing that. So,
Cool. Got a couple wrap up questions here that we ask all the guests. We mentioned Rich Dad Poor Dad. So, excluding that book, are there any recommendations, or maybe it's even a podcast or some other source of information that you think listeners might gain a lot of value from, Danny?
I mean, I love the classics, Think and Grow Rich, hard to beat that. I've been listening to a lot of new ones lately. Atomic Habits has been great. There's it depends. Like if you're looking to do, business or family, like right now, I just got done with the boardroom meeting, 18 summers with your kids. That has been phenomenal and implementing that. Parenting with love and logic, again, has nothing to do with real estate, but I'm a father of two, 4 and 6. So, been doing a lot, really working on kind of the family aspect. And then, for real estate, there's a lot of good ones out there, but The Titans of Real Estate, that was a great book. And yeah, I mean, there's
What was the Titans of real estate?
so it just talks about kind of the titans out there that owned massive portfolios. So some of these REIT managers, fund managers, guys like Sam Zell. So it's super interesting to like listen to it from a guy or from a lot of different titans out there that had multi-billion-dollar portfolios.
Interesting. So the crown jewel of wisdom, Danny, if you could go back to 2009, knowing everything you know now, what would be the crown jewel of wisdom you would share with yourself then?
Oh man. Okay, so two things. I really, really look when there's a crash, when prices are dirt cheap, understanding lots of different types of real estate, I think is really, really, and markets as well, is really beneficial because then you can just swoop up everything and swoop up as much as you can and hold for the long term, man. Like I look back at some of these deals and I'm just cringing at why I sold too soon. And not just even holding for cash flow, because the cash flow today, a decade later, just looking at it would be absolutely game changing. And I'm like, why did I sell? And yeah, the time I'm like, oh, I'm making, a couple 100,000 or $1 million or whatever. And like, yeah, it felt great in the moment. But to look and see how those assets are now performing, it's just, man, you cringe you cringe a little bit thinking about it. So I would say, going back to the philosophy of holding the really quality assets for the long term, especially if you got in at a really great basis, just let time do its thing. And, with inflation in your rents, it's just going to be incredible cash flows. So that's definitely, if I would go back, I would have gotten a true triple net leases sooner, and I would have built a little bit of a team sooner, and I would have held a lot more.
Love it. Where can listeners get more Danny Newberry?
So they can reach out to me. Our website's vailcommercialgroup.com. We do a lot of joint ventures. We do a lot of partnerships where, somebody who may need help with, financing or, signing on debt or, bringing capital to a deal, management, whatever it might be in a project. We're always interested in getting involved in, stuff that meets our criteria, especially if it's in the Southwest or Rocky Mountain region. So we do a lot of those type of partnerships, and you can reach out to me at danny@vailcommercialgroup.com, and we can schedule time to talk.
Sweet. The final question I ask all of my guests, what is the kindest thing anyone has ever done for you, Danny?
Wow, okay. Man, that's a tough one. Okay. I really got to think about that. I've had a lot of things in my life that I'm very blessed to say that I have great people in my life. But the kindest thing is my mother bringing me into this world. Can't beat that one.
I love it. Mom,
Yeah, mom. Thank you.
there we go. It's a great place to start and a great place for us to finish. Danny, thank
Awesome.
you for coming on the show. I got a couple pages of notes here. Had a good time. Really appreciate you joining us here.
Yeah, and it's been awesome. Thanks again for having me on. Really appreciate it.